What will happen if the property market actually falls by 35%? I'm a chartered accountant from London and I help people deal with finances and tax. I want to discuss a possible scenario as suggested by some property experts. What if property prices in the UK fell by 35%? This would be a significant drop from the current average property prices of £285,000. Property prices are already down from the all-time high that we saw recently, but a 35% drop means that house prices could be around £185,000. Of course, that's the average, and depending on the area and the property types, you will have different property prices as per those factors. As an accountant, I do get to see some information before everyone else. When we are dealing with clients, some of them are building houses, they're refurbishing houses. They could be at a stage where they're looking at buying houses or selling houses. And as soon as there is a slowdown in the house buying activity, and what we saw recently, I was actually ahead of everyone else. And I even made a video on this topic that predicted a drop in house prices. As you can imagine, the video was not well received by everyone, but now that the official data has confirmed a decline in house prices, the information that I was sharing many months ago was indeed correct. So let's start off this conversation by discussing the current house prices. Although the official sources and mortgage lenders they've confirmed a decline in house prices on a yearly basis, the current reduction is too small to be considered a housing market collapse. I mean, you can't call it a housing crash. The average prices as per Halifax fell by 2.6% in June, and now an average property costs £285,932. And this is down from on average of 293,000 in last year's August. So there is a decline, but you can't call it a crash. What would a 35% drop look like? It means that the average price will be around £185,000. It would seriously hurt properties in London as they tend to be more expensive than the rest of the country. However, it is a very bad scenario for the Britain's housing market. The next point that I want to discuss is negative equity. I believe this is an extremely important point that affects the house buying activity. The rate of unemployment currently is extremely low in the UK. And even though interest rates have gone up, there are people who can still afford to buy better houses and use their residual income to pay the higher rate of interest. However, so affordability may not be a problem for everyone. However, negative equity is now a real concern for lenders. If there is a change in circumstances and homeowners for any reason cannot pay the mortgage payments, lenders will lose serious money when selling those assets. And this will further damage their balance sheets. And even if there wasn't a housing crash, these types of transactions could create a crash. What I'm hearing from my clients and generally from my industry is that the above average houses are now difficult to sell. There was a risk in the past that you've sold your house, but the buyer is not able to secure a mortgage based on the price that you've agreed. At the moment, due to the uncertainty in the market, people have stopped viewing houses. And I'm talking in general. I understand that some people may still be buying houses, but in general terms, people have stopped viewing houses. Last year, you would struggle to get an appointment to even view a house. I remember, you see an ad, you like the house, you call the estate agents and they're ready to tell you that, by the way, we are fully booked and it's likely that we will achieve the price that we are looking for. But right now, sellers are being realistic that they will not achieve the asking price, and still not many people are coming forward to view houses. I believe that we will see a significant drop in the house buying activity, which overall is not a good sort of sign for for the British economy if that happens, because lots of industries do rely on the property market, and the property market is stronger with house prices going up. So let's explore different scenarios based on the type of mortgage product you have. And when I say that, I mean loan to value ratios. So if you've recently purchased your house, you have a 90% loan to value mortgage. So if there is a 35% drop, it would mean negative equity, and it would be a drop of let's use the average house price as £71,000. And what it means in simple terms is that you owe more money on your mortgage than what the property is worth. Property landlords, on the other hand, they would normally pay more as a deposit. So, they would put in a 75% loan to value deposit. So even with a 35% drop, their negative equity would be sort of £28,000. Many landlords buy properties below the market value. So, they may not even face a negative equity at all, because, the deposit is good enough to cover a sort of, a normal drop that we are expecting or everyone else is expecting. And if they've bought below the market price, they're still in positive equity. I believe landlords are best positioned in the current scenario because they are expected to pay higher deposits to cover negative price movements. When faced with negative equity, homeowners have a few options. They can choose to keep their property, as historically property prices tend to recover over time, or they can decide to sort of hand the keys back to the bank, effectively giving up the property. This decision will have severe consequences for their credit rating, and it would make it very difficult for them to secure loans and mortgages in the future. So that's the extreme scenario that you could be facing. If property prices were to drop by 35%, it's likely to lead to sort of a huge number of economic, social, and political problems. A property price drop means that the economy is slowing down. It leads to job losses, redundancies, and that's the reason why I believe that government would try its best to not allow it to happen. With the property values decreasing, many people may find themselves in financial hardship, struggling with short-term loans, credit cards, sort of payday loans. This could lead to poverty and financial difficulty for people. And this could increase crime rates in this in your area, fraud, theft. People may get frustrated with tensions running high. There could be a civil unrest and political instability because people would be, unsatisfied with the government. So I believe that government, they have access to lots of information and data before everyone else. So if this is going to happen, they will know before everyone else because they, keep record of all the official information. And it's likely that they could intervene to stop that from happening. Okay, so a 35% price drop is a hypothetical scenario and it may never happen. But it's important to make sure that you're making informed decisions when it comes to buying your next family home or your next investment property. And, it creates opportunities as well. There's a saying that goes something like, millionaires are creating during market crashes. I don't know the exact words, but that's sort of what it means. And historically, if you look at property price chart, they do recover over time. And if you sort of buy now or in the next 2 years, because, property prices are likely to sort of continue to decline in the next sort of 18 to 24 months. So if you were to buy and hold during a property crash, you've effectively got yourself a bargain. But yeah, it's important that you're running all the numbers and you're comfortable with the decisions that you're making. I hope you found this video useful. If you'd like to stay connected, please don't forget to like and subscribe to my channel. I look forward to seeing you in the next video.